All right, fantastic. Welcome to Coffee with Markus. Today we're going to talk about what's happening in the markets. And wow, what a day! I got to show you what's happening there. But this will only take us 2 or 3 minutes. And then we will talk about trading with margin, what you need to know, and how to avoid these dreaded margin calls. And next, I'll give you an update on my account. I'll show you my current trades and also show you how my positions are doing. And after this, I'll answer your questions. So put them in the chat right here and I'll answer as many as I can later in the show. So as you can see, we have a full program. So let's get started. This show is about real money and real trades. I'll show you the trading strategies that I personally trade, the tools that I use to trade my own accounts, and we will talk about the right mindset of a trader. Now, talking about mindset, I'm going to show you how to create SRC profits. And SRC stands for systematic, repeatable, and consistent, because that is the key to long-term success in the markets. So, if you are sick of all the hype and empty promises, and you want to learn trading strategies that actually work, then click on like right now and let's get started. All right, let's get started and let's take a quick look of what's happening in the markets. Today is January 31st and today is officially, apparently, the day of the bounce. We're looking at the S&P 500, and after the S&P 500 index was on track for the worst months since March 2020, since the pandemic began, we are up right now. We're up 1.3%. And if you're looking at a 5-minute chart here, we see that this morning we were moving higher and ever since just up, up and away. Also the NASDAQ, very similar here on the 5-minute chart. And the NASDAQ was on track for having the worst months ever. I mean, at first they said worst months, worst January since 2008. But now then they said worst January since ever. Now you look at this, a bounce back of 2.55%. And you see, it's not only here, it's also in individual stocks. You remember Netflix, we talked about it, really got beaten up after reporting quite disappointing earnings, at least in the eyes of some investors. Today up 10%. So there is a bounce. Tesla, I mean, got to take a look at Tesla also last week being down. Today up almost 10%. Marching towards the 1,000 level here again. So definitely something going on there. And Spotify, so, Spotify in the news right now. And after going down here from where? How much is this? Is that a drop of, almost 50%, almost 50% drop. Today, a 13% bounce. So, I mean, as I said, today is the day of the bounce. And as we can see, I mean, January was quite volatile. It is the last trading day of the month, and we'll see where we end. So we have another, 25 minutes or so in trading. So we'll see if we can finish. Right now we are trading at highs of the day. So, and as always, we'll also talk about my positions and how they're affected by this volatility in just a little bit. But first, let's talk about buying on margin. Actually, no, let's start over because I want to make sure that I get this right. And I want to just switch something here on the screen. Okay. So let's talk about trading on margin, how to avoid these dreaded margin calls. So what we'll talk about is what is margin. I'll give you a very specific example. Then we'll talk about the advantages of margin trading. We'll also talk about the dangers of trading on margin. We'll talk about what are these so-called maintenance requirements. What is a margin call? It's something bad when it happens. So we got to talk about this and how do you respond to a margin call? And then we'll also talk about portfolio margin. So as you can see, a lot to talk about. So let's get started and let's talk about what is buying on margin. Or margin is basically borrowing money, borrowing money from your broker. And that's quite interesting. You see, you can think of it as a loan from your brokerage. And because margin trading, as you'll see in an example here in just a moment, allows you to buy more stocks than you'd be able to do normally. Now, to trade on margin, you do need a margin account. And you see, this is different from a regular cash account in which you trade using the money that you have in your account. Now, by law, your broker is required to obtain your consent to open a margin account. So the broker cannot simply turn your account into a margin account. Doesn't work with this. But you see, the margin account may be part of your standard account opening agreement, where the broker asks you, what account do you want to open? Do you want to open a margin account and we will give you more money, or do you want to have a cash account? Now, by law, an initial investment of at least $2,000 is required for a margin account, but some brokers require more. And this deposit that you have initially is also known as the minimum margin. And once the account is open and operational, you can borrow up to 50% of the purchase price of the stock. Now, this is important. So let's just say that you would put $10,000 in cash into a margin account. So this means you can borrow another $10,000 from your broker. Now, you don't have to do this. It's basically like a line of credit. So you can borrow less or you can borrow not at all, right? So this is what you need to know. Now, the important thing is you can keep your loan or the margin as long as you want, provided you fulfill your obligations, such as paying interest on time. And when you sell the stock in a margin account, it's pretty much like selling your house, right? I mean, at first, the proceeds go to your broker against the repayment of the loan. It's pretty much like a mortgage, right? When you sell your house, the bank is being paid first. Now, there's a restriction called the maintenance margin, which is the minimum account balance you must maintain before your broker will force you to deposit more funds or sell stock. And when that happens, it's a margin call, and we'll talk about this in a moment. But let me give you a very specific example first of what a margin is. So let's say you're putting $10,000 in cash in your margin account. Your broker will loan you another $10,000 up to, again, you don't have to. And this means that you have a buying power of $20,000. So let's just do an extreme. And let's say with this buying power of $20,000, you are buying 100 shares of a stock that is worth $200. Right? And so this means that now you're using every single cent of your buying power in the account. But there's a reason why we are using this extreme here. Now, when you do this, $10,000 of this $20,000 is your cash, and $10,000 is the loan from your broker. And on this $10,000, you'll pay interest. Okay, so why would you even consider doing this and trading on margin? Now let's just start with the fun example first. Let's just say the stock rises, and let me actually change this to a nice blue color because there we go. I like to have it nice and orderly. So let's say the stock rises by 25% from $200 to $250. Okay, what does this mean? Now your portfolio value, so your portfolio value is 100 shares that you have, right, times $250, $250. So this means it is $25,000. Okay. So now keep in mind, right? I mean, these $25,000, your portfolio, actually, you have a profit. It went from $20,000 to $25,000. So you have a profit of $5,000. Now, based on the $10,000, these were your $10,000. So based on your $10,000, that is a 50% increase because you made $5,000 based on your original $10,000. So that is pretty cool. If you think about it, the stock only rose 25%, but you made twice as much money because you leveraged your account, you used margin. Okay, so yay, this is the great news. But let's talk about the dangers of trading on margin. So now let's do the other way around. Let's say the stock drops by 25%. Right, and it drops from let's say $200 where you bought it, okay, to $150. You get the idea. So what is your portfolio value? So your portfolio value is now 100 times $150. So that's $15,000 that your portfolio is now worth. Okay, so how much are you losing? Well, you had $20,000, now you only have $15,000. So this means that you have a loss of $5,000. Now, again, there's one more zero. There we go. Okay, now based on your $10,000, this is a loss of 50%, even though the stock only dropped 25%. So as you can see, leverage and margin is a double-edged sword. Yes, you can make money twice as fast and you can lose money twice as fast. So let's talk about these maintenance requirements and these dreaded margin calls. Okay, so first of all, this is where you need to understand we have something that is called the initial margin, and the initial margin is 50%. And what does this mean? It means that 50% of your total value of the portfolio can be margined, right? So this is where, as we said, if you have a $20,000 buying power, right? So this means that $10,000 of this can be margined. And this is the loan from the broker. So now let's talk about the maintenance margin. Now the maintenance margin varies from broker to broker, but it's typically around 25%, could be 35%. Please check with your broker, right? So let's just talk about this, of what this means and what impact it has. So let me give you another example here, and we're still doing our $10,000 example. So we have $10,000 in cash, and we have the $10,000 loan from your broker, which is the margin, right? So this means we have $20,000. Now, let's say that our stock that we used in the previous example here, let me move this a little bit higher. So let's just say that our stock drops by 20% to $160, right? So again, what is now our portfolio value? So our portfolio value is now 100 stocks that we had times $160 is $16,000. So now the question is, okay, how we're doing here with the maintenance margin requirements? Well, this is where we have the $16,000 times we take the 0.25, which is 25%, means that the maintenance margin requirement is $4,000. Stick with me because this is important. This is what very few traders understand. So let's take a look at this. We have a $16,000 portfolio value, right? And we have a $10,000 loan that we received from our broker. Okay, so and now we need to subtract, and this is important, the $4,000, which is the maintenance margin. Okay, now if we do this, how much money do we have left? Well, we have $2,000 in excess. So we are good. We are golden. So no problem here. Okay, now let's say that the stock keeps dropping, and let's say the stock drops by 20, let's say to 140. So it drops to 140. So stick with me. This is super important. This is what very few traders who are trading on margin understand, how this maintenance margin works. So now your portfolio is worth $14,000, right? You have 100 shares times $140. Again, we are calculating how much is the maintenance margin that we need. And this value, the 0.25, again, it's 25%. Your broker might actually maybe require 30% or 35%. So you need to understand how much it is. Okay, so if we are taking this times 25, we are ending up at $3,500. Okay, so this here is, again, the maintenance margin requirement. And let's see if we are still golden or if we are getting a margin call here. So now the portfolio is worth $14,000. We have borrowed $10,000 from the broker, so we have to pay this back. This is our loan. This is the margin, minus $3,500, and we are still good. We have $500 in excess, so we are still good. No margin call yet, but here it comes, okay? So let's say the stock drops to $120. So again, now your portfolio is worth $12,000. We're taking the 0.25, and how much is that? If it drops to 120, this is $3,000. There we go. Okay, $3,000. And this is now the maintenance margin requirement. Are you with me thus far? Super important that you understand it. Did you know that? Let me know in the comments if you knew all this or if this is new information here. So let's talk about it. Now we have the $12,000 is your portfolio minus the $10,000 loan from your broker that you took out in the very beginning. In the very beginning when you bought the stock for $200, right? Minus $3,000 maintenance requirement. And what is happening? Oh, now it is $1,000 negative. Okay. So what happens when it is $1,000 negative? Let's actually mark this in big red so that you know here with the excess, we were good. Let's mark this in green. And also with this excess, we were good. Let's mark this in green. No problem here. But now let's talk what happens when you are negative. So you see, because you still have to pay back the whole $10,000 loan. This is when you are getting a margin call. So what is a margin call? I mean, just technically it is a demand from your broker, right? To add money to your account or to close out your positions, right? So that you can pay back the money that you own the broker to bring your account back to the required level. So if you get a margin call, it's typically an email that the broker sends you, and make sure that you're not ignoring this. So how do you respond to a margin call? Well, you have two possibilities. Number one, you could sell your position. What would happen if you sell your position? Well, again, it is $12,000 is your portfolio worth right now. So the stock is trading at 120. So you have to give the broker back $10,000. And this means that right now you have $2,000 left in cash in the account. And again, since you were trading on margin based on your initial $10,000, this means that now you have an 80% loss, even though the stock dropped only 40%. Okay, what is the other possibility? The other possibility is that you send the broker more money. Okay, so the question is, how much time do you have to actually fulfill the demand from your broker? So let's write this down here. So how much time do you have? It really depends on your broker. Let me show you example number one. Example number one is Tastyworks, and you see maintenance calls are typically due 3 business days after the call is issued. So you have 3 full days. That's not at all. But you see, but Tastyworks reserves the right to require maintenance calls to be met sooner. So pay close attention to your email, because in the email, they might tell you you only have a day or 2. Now, very, very important. Who here is on Interactive Brokers? If you're on Interactive Brokers, you need to understand this margin call. When the balance in a margin account falls below the maintenance requirement, the broker can issue a margin call, blah, blah, blah. And here's the important thing. There are no margin calls at Interactive Brokers. What? What does this mean? Well, let's go back here to our handy dandy notepad and write down. So how much time do you have? We talked about this. This would be anywhere between 24 to 72 hours. Typically, again, check with your broker. So what happens if you ignore the margin call? And or if you're with Interactive Brokers, if you do not meet the margin call, your brokerage firm can close out any open positions in order to bring the account back up to the minimum value. And your brokerage firm can do this without your approval, and they can choose which positions to liquidate. Now, as you can imagine, this is the worst case scenario because they just choose any of your positions. So in our example here, right now, we only have 1 position. So it's super easy for the broker to choose. But if you have multiple positions, you have to be super careful because now you lost control. So long story short, what does this mean? It means never, ever ignore margin calls. I mean, do something, either sell your position or send the broker more money. Now, super important, you might see it here also, right? The fastest way is to send a wire transfer. Don't do ACH, don't send a check, because the broker doesn't care when you initiated this. They only care when is the money back into the account. Okay, so As you can see, margin, to understand margin, is super important. Now let's very briefly talk about portfolio margin, and we don't spend much time on this. So portfolio margin is margin for bigger accounts. And you see, every broker is using here a different measurement. Some brokers allow you to apply for portfolio margin when you have $125,000, could be as much as $175,000 or maybe even $200,000. It really depends on your broker. So why is it more here? Well, it usually gives you a much larger margin. And so previously here we had the $10,000, or let's say $100,000 would turn into $200,000. Right, so this is with the so-called regular margin, or this regular margin is also called Reg T margin. I don't know what the T stands for, it doesn't really matter, but this way you get an idea. This is the regular T margin. Now, if you have portfolio margin, $100,000 could turn into up to $610,000. This is with portfolio margin. So as you can see, you get much more leverage, and as you already know, leverage is a double-edged sword. Now, again, why do I say up to $610,000? Well, there's a quite complicated formula. I got this here from TD Ameritrade. You see, with portfolio margins, stocks and options are tested by hypothetically moving the price of the underlying between plus and minus 15%. The price ranges are then divided into 10 equidistant points, and the loss or gain on the position is calculated, and blah, 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 blah. What does it mean? It's complicated, and what it basically means, it is subject to change all the time based on volatility. So this is why portfolio margin is super tricky. It is super dangerous. You need to know what you're doing here. But as I said, I promise you that I'll tell you the things that you need to know. Now you know what margin is. You know the advantages of margin trading. And this is always the exciting part. This is what most people are talking about. Yay, it's so fun. You also know the dangers. And please, 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 if you still do not understand these maintenance requirements, please watch this video again, pause it, rewind it. This is where I gave you many examples here. When you get a margin call, do not ignore it. It's the worst thing that you can do. Well, if you're with Interactive Brokers, they're not issuing any margin call. They immediately liquidate this. And you also have a better idea of what portfolio margin is. If you found this helpful, give me a thumbs up, and I'll also have some other videos popping up right now. Take a look at these so that you know how you could use margin in your account. All right. Good. As you know, this will be the part that the video editor is editing out. And I want to take a look here at your questions in a little bit, but then also want to make sure that we do have enough time to take a look at my current trades, my current positions. But I know that margin is one of the challenges that many people have. So, I mean, has this been helpful? If maybe you already knew all this, but you see, most people get hung up with the maintenance margin. And make sure that you know the multiplier that your broker is requiring. Is he requiring 25%, which is kind of an industry standard, but for some stocks or ETFs, it could be different, or based on the amount of money that you have in your portfolio, and based on your experience, your broker might say, you know what, why don't we start off with 30% or 35% here? All right. Good. So good to see you. And yeah, then Firali says, looking forward, Farantelli, sorry. Looking forward to this one. It is an important subject here. And yeah, you see, that's the deal. On the brokerage platforms, it's not easy to see it, how much of the access you have. It really depends on your broker platform. So therefore, that's why I wanted to give you this very simple formula that you can calculate it for yourself. Okay. All right, so when you start with shares, everyone loses money. Okay, well, it depends, right? I mean, you can trade stocks, you can trade options. It really depends on what you trade. The important thing is that you have a trading strategy. And what does a trading strategy do? It explains the three things. Number one, what are you trading? What stocks or what options are you trading? Number two, when do you enter? Number three, when do you exit? Okay. Good, good, good. Kyle says, I'm a little bit leery of this bounce. We shall see, right? I mean, right now on Friday, we have the jobs report, so that's coming up. But other than this, we have earnings. We have Apple reporting earnings Apple we had last week. But we have Facebook, Google, they are reporting earnings this week. So we'll see how these guys are doing. And we shall see if there's anything else. Hubert says, why is it the wheel is getting no suggestions today? Because it's an update. When there's an update, you want to sell calls. And I'll show you in a moment of what I have been doing today. So I sold 2 calls against my existing positions. You see, in a nutshell, when the market is going down, as it did last Monday was fantastic. There were so many choices on the wheel scanner, right, that was hard to keep up, right? And then today, when the market is just rallying, here's the deal. You will see most premium when a stock is going down. And you see today, if you have a strong uptrend in the market, if you have a strong update of 2%, 2.5%, and you see a stock going down, do you really want to sell puts on this stock? Just imagine what will happen if the overall market shows weakness here. Anyhow, hey, Teresa. So good to see you. And Teresa, Coach T is already explaining it. Very few wheel suggestions on an up day, most of them on a down day. And this is where it's important. Be patient. We had our mastermind strategy call a little bit earlier, and this is where we talked about don't just throw on trades because it's Monday, because you had options expiring last week, and now you say, oh, well, I need to fill up my portfolio here. So what do I do? Where are all the trades? Let's do this. Now, pay attention to the markets here, and always keep this in mind, follow your plan, okay? Do not let your emotions dictate what you're doing. We all feel emotions, that's fine, right? I mean, you can be excited about an up day, you can be down about a down day. The important thing is that you do not let your emotions dictate what you are trading. Okay. Good. So what other, Tony's asking, when we are trading on a stock that has 45% margin after one night Robinhood increase to 100% covered, can we sue Robinhood? No, you can't, because here's the deal. When you open a margin account, Robinhood explained to you everything, and Robinhood basically did the same thing that here Tastyworks does and that every other broker does, where they say, you know what? We reserve the right to require maintenance calls to be met sooner or to change it at any given time, right? This is just part of the deal. And this is where it's important that you have a right broker. And Robinhood in the past has been known to do kind of this weird stuff. And that might be one of the reasons when we look at the Robinhood stock price that ever since they IPO'd, so they started trading publicly, it has been going down, because I do believe that they had a very different business model, as you might know, right, where they can very quickly liquidate you here. Anyhow, good question here. Good question. And Zia also says, Charles Schwab changes margin requirements abruptly if the stock is becoming volatile or plummeting quickly. Yeah, you see, with portfolio margin, it is built in, but with regular margin, it can also happen. I mean, the broker can suddenly say, you know what, we're no longer providing margin for this stock or this ETF. Or your broker might actually say, you know what, instead of the usual 25%, this is going crazy. I mean, recently we had UNG. Let's take a look at this, right? So if you, let's go back there. Let's take a look at an ETF like UNG that is suddenly going crazy. You see, from here to here, within a few days, that's a 34% drop. And also on the other hand, here within the last few days, we had a 40% gain, right? And so if it goes too crazy, your broker can absolutely change the rules on you. So that's important to know when you are trading on margin. So yeah, Nita says it, E-Trade changes margin requirements too. Every broker does, because eventually, I mean, ultimately they have to protect themselves, because here is the deal. Let's just go back to our handy dandy notepad here. So you see, let's just say, let's go to this example here, and let's just go to an extreme example, and let's say that the stocks drops to $80, okay? So now you have only $8,000, and well, we don't have to calculate everything else. And the broker has loaned you $10,000. So now you're $2,000 in the hole. right? And your broker will say, well, send me more money. And see, especially there are a lot of Robinhood traders who only have these $10,000 in their account. They don't have anymore. And now this is where the broker has to eat the loss. I mean, I don't know exactly. They might sue you, probably not for $2,000 or something like this. So the broker has to eat it. So when the broker sees, oh, this stock can quickly go from, I don't know, $200 to $80, this is when they change the rules to make sure that they are not sitting on a loss here. I think this is important to know here. But yeah, good questions. This is why they change it all the time. All right, Dave says, new info. Good. Okay. I hope that it helps, especially when you're trading on margin here. So Steve says, I've been told to never use margin as you're using someone else's money. Again, this is where, think about it this way. Would you only buy a house if you have all the money in cash, right? Maybe this way you are wired this way and this is how you do it, or maybe you use a mortgage. What about a car? Do you finance a car or do you pay it in cash, right? It really depends. It is definitely safer if you are only using your own money, right? But when you know what you're doing and you know the risks and the rewards, it might make sense for you to apply leverage. This is where, again, Steve, I mean, I think it's a great comment and you need to understand what works best for you. I'm not saying it one is right or the other. You know that I am using margin. I am trading a margin account, and I have been trading for what, 20 plus years, 23 years or something like this. I don't even know how long. It has been a long, long time. So this is why I am comfortable using margin here. Okay, so this is an excellent question here. Does a margin call affect your credit rating? No, it does not if you're meeting it, right? If your broker has to close out the trades, as long as you don't owe the broker money. So this is where we are going back to this. It's a great question, right? So as long as the broker is getting his money back, right, we're all good. The problem starts, and this is where it might affect your credit report, when it drops below the loan and you cannot pay back the broker and you say, well, you know what? I know that I owe you $2,000, but screw you, right? I mean, that's probably never a good idea here. Okay, so do I use margin in both PowerX and the wheel? Yes, I do. Yes, I do. Although you see, for PowerX, you don't really need margin. For the wheel, it's dangerous. Be aware. I use it. I'm not saying that you should do it, but you have been following me for a while probably, so you know exactly of what is happening. All right, Nita says, understood margin, but not margin maintenance. That's good. And yeah, thankfully haven't had a margin call. Again, your broker can change this. Okay, so let's actually take a look at some of the trades that I'm in, because I mean, this has been just a fun week. So let's see. Let's actually start with ADI. We go in alphabetical order. You know what? No, let's go through one account first and then the other account. As you know, right now, I am trading two accounts. Why am I doing this? Because I'm closing the Tastyworks account, and it takes up to 2 weeks to transfer positions over. During these 2 weeks, I could not trade, at least not the way how I want to trade. And this is why I'm winding down the one account. So I had 5 positions in there. BA already got called away. That's Boeing. UNG got called away. That's the natural gas ETF. LVS is getting there probably in the next 2 or 3 weeks. It's getting called away. So we will take a look at these positions. But right now, since the beginning of the year, I'm doing all of my trading, besides managing the other positions that we'll talk about in a moment. I do this in a Tradier account, and I want to show you what exactly happened here. So we start with ADI, and I mean, this was fun. ADI, I actually sold, or we sold the 162.50. Boom. Puts. Let me see. Where's my horizontal line? I thought that I can draw a horizontal line there. No, I cannot. Oh. Let's see, 162.50. Somewhere around there. Draw a horizontal line. There we go. Okay, so this was great. Sold it, got assigned, sold some calls against it. was able to buy back the calls, sold some more calls against it. So this here has been a fun one. If this stays above 162.50, I'm getting called away, keep all of the premium. If it drops below, maybe I can buy back my calls here. But this is definitely working quite well. On Friday, I sold the 192.50 right here. Let's see if I can now. Gosh darn it! I thought there was an easy way, an easy shortcut. Doesn't seem to work. We do it this way. Get the idea. Sold this put and expiring this Friday. So if it stays above, I will just keep the premium here. And I'll show you in a moment how much premium I received there. And then we're good to go. If I am getting assigned, I will own stocks according to the wheel strategy, and I will sell calls against it. But here also, this is looking good and having fun. CLF, interesting. So I sold the 20 put a couple of weeks ago. So here, got assigned, and right now we have a nice bounce back here today. So today is bounce back day, but here I've not yet been able to sell calls. So right now I just have the premium from the puts. I needed to go a little bit higher. I looked at today, my head coach Mark and we discussed it of possibly selling calls that expire next week, but today is just Monday, so I wanted to wait and see if we have a little bit more of a bounce here. Okay, IWM, wonderful, beautiful. So here I sold calls at 205.50, got assigned at 205.50. No, 205. It was 205 exactly. Let's see if we can lower this a little bit. Yeah, you get the idea. Right, and this was already perfect. This is picture perfect. Last week was able to sell calls, buy them back, selling more calls. So here right now, just making premium. This works. Was thinking about selling calls today, but then I thought, if I would sell calls today, I would probably get around 35% annualized or maybe even 50% annualized. And I said, you know what? I'll hang on to this and see if tomorrow I can get probably 50 or 60% annualized. So this would be good. Yeah, by the way, let me just show you this here where I have the calculator. And you see, today I could have gotten probably $1 for 36% annualized. And I said, yeah, you know what? I want to shoot for $2 and go for 70% annualized. So, okay, let's keep going down the list here. So ADI today sold calls for $1.55, so collected $930 in premium. Let me zoom in a little bit so that you can see it better. So that's good. They're expiring on Thursday, so almost $1,000 for a week is not bad at all. So JP Morgan, another fun one, got assigned here at 149. So 149, and this was already last week. So you get the idea right here, and was able to sell calls, buy them back, sell more calls, and here today on JP Morgan, sold them at 90 cents for annualized 44%. JP Morgan kept rallying, but this morning when I saw the pop, I thought, okay, let's just sell that. And this is what I did. At the end of the day, I would have gotten more, but $720, nothing to sneeze at. Okay, so now let's move on to the Tastyworks account. And in the Tastyworks account, I still have ARCF. ARCF, I got assigned at 47.50. So I've been able to sell puts, but ever since then, not been able to sell any calls. I think in the very beginning, I've been able to sell some calls. And here now I want to wait until we see a bottom before I consider flying a rescue mission. And if you would like to know what it is, flying a rescue mission, I'll leave a link in the description here. So right now with this one, I'm just waiting of either making sure that I found a bottom. And if so, I'm planning to sell right here some 28 puts. So that is the plan right here. Or if now we have a V-shaped recovery, then I will just sell calls here. So this is what's going on with ARCF. Today up, wow, 8.4%. Woo-hoo-hoo, that's not bad at all. LVS, super interesting one. So originally I got assigned at 58, right? And then I lowered my cost basis a few times, and my current cost basis is 46.86. I collected a lot of premium on this. My break even is actually at $42.40, I believe. So if right now I would close out this position, I would close it out profitably. And as you can see, I mean, at some point, this position was heavily, heavily underwater. So this position at some point was underwater by what? 40%. Once I close out this trade, I'll do a full deep dive of what happened, how I was flying the rescue missions, how I handled this bounce, what I did on the next retracement, what I did on this bounce. So I'll give you a play-by-play here. But I first want to close it out so that I can show you exactly how much money I was down at some point and how much money I actually made as I got out of the trade. Again, this trade is not over. Right now, if I would exit it with a small, probably $2,000 or $3,000 profit. I'm planning to exit this with probably closer to $10,000 or $12,000 in profit. So I will definitely keep you posted there. Now, right, what do you know? Right, today had the best day in a long time. Look at this, up 22%. So right, today was actually, if you look at a 5-minute chart, this morning going higher, battling with the $3 mark, trading as high as $3.14, then trading down again to $2.95 and finished, boom, $3 on the dot, up 23%. Now, obviously, this year is not enough to sell calls, but hey, at least we're moving in the right direction after 4 weeks, moving in the wrong direction. One of these birds, what do you call these birds? Swallows? Don't make a summer. So no, let's not just get overly enthusiastic and say, let's all buy ride. No, but it's good to see that this is finally going in another direction. So it just, January has been a great month for trading. I mean, today is the last trading day and I placed a few more trades today. So I haven't closed out completely January, but it seems, let me just show you, and we have to wait until I get the statement. So right now I just exported this stuff here. And as you can see, oh no, you can't see it. So on the Tradier account, I was able to sell a lot of premium. So it has been $23,000. This does not include the trades that I did today. So, I mean, it could absolutely be that I might have my best months in selling premium in a long time. So we'll see what happens there. Now, the Tastyworks account also need to wait until all the dust settles here. But I have been able to sell, let's see, if we move over there. Yeah, as you can see, a BA call, LVS, lots of LVS trading here, UNG, so collected around $5,000 on that account. So, I mean, overall, between these two accounts, and again, keep in mind, I am trading right now 2 accounts. One is the phasing out account, right? I mean, this is where I'm just closing the position. So in the Tastyworks account, I'm not entering any new positions because Tastyworks has been horribly expensive, cost me thousands of dollars in commissions. And in the Tradier account, I do not pay anything in commissions, which I like a lot. And this is why I'm taking the trades here. Anyhow, good. So let's just see if there's a few other comments as we are going through the trades here. And yeah, Hunter said, had an Interactive Broker email last week while on holiday. Luckily, I had the cash to inject or nearly paid all off. Interactive Brokers is dangerous here. So no, Tradier does not have portfolio margin yet. The maintenance margin requirements are 25%. And again, subject to change, can change tomorrow. So please contact them to be sure. If you're watching this video here, and again, even right now, they could change it right now. So always make sure. Yeah, I mean, John says, I don't use margin. Find it interesting. It's just something to know. You don't ever have to use it, but it's good to know that it exists, right? So Les Moore says, do brokerages typically remove a margin call if the stock moves back in your favor the next day? Yes, they do. But be careful. You don't want to bet on this, right? I mean, for example, if you had Netflix going down and you got a margin call, you don't want to bet that Netflix bounces right back. So what I would say is probably the safer way, less is more, is maybe even just wire some money into the account. If the stock bounces back, you can wire the money right back again, right? And so this is where it's probably the safer way. But yeah, you're right. If it bounces right back, then the margin call will be removed here. Okay, yeah, a market move can eliminate the deficit. Absolutely. Absolutely. Okay, Junior says, I've always paid cash for cars. That's great. Yeah, and again, I'm not saying that there's right or wrong. The reason why I'm telling you this is so that you know about it, and then you can make a decision whether this makes sense for you to trade on margin or not. If you're new to trading, and if you don't understand the concept of maintenance margin and margin calls, and if you also don't have additional cash that you could put in the account, don't trade on margin just yet. And you might not have ever to trade on margin. You can choose not to do this. That's absolutely fine. That's absolutely fine. Okay. Good. Evgeny says, with so many stocks down in October, did Tastyworks issue a margin call in your wheel account? No, they did not. They did not issue a margin account. I have not received any margin account, any margin calls here from Tastyworks. Have I? No, not that I'm aware of. I would have to dig through my emails here. Okay, so Richard says, thanks for explaining this. I have a margin account for convenience. Great. Okay, yeah. Treat like cash, keep a positive balance. Yeah, LVS, woo-hoo-hoo. It'll be just fine. So if you're profitable on LVS, why is your cost basis higher than the stock price? Well, the cost basis is what I bought the stock for, and then I collected a lot of money here on in premium, right? And so the cost basis is what I bought the stock for. The break even, it's different. The break even is the cost basis minus all the premium that I have received, right? So super important that you understand the difference here, Jeff. Is this making sense? Right? So there's a difference between cost basis and break even. All right. Well, it is 3:16. We already a minute over here, but it's fun to talk about this and to show you what's happening. These markets are definitely fun to trade. Well, if you enjoyed today's show, give me a like on your way out and watch any of the other videos that I have on the channel. Really appreciate it, and I'll see you in the next video. Take care, everybody.